This is a demonstration of exercise 817 journalizing transactions using the direct write-off method. On June 1st, 2024, Best Performance Cell Phone sold $21,000 of merchandise to Anthony Trucking Company on account. Anthony fell on hard times and on July 15th paid only $5,000 of the accounts receivable. After repeated attempts to collect, Best Performance finally wrote off its accounts receivable from Anthony on September 5th. 6 months later, on March 5th, 2025, Best Performance received Anthony's check for $16,000 with a note apologizing for the late payment. And in the requirements, it asks us in Part 1 to journalize the transactions for Best Performance cell phones using the direct write-off method and ignore cost of goods sold. So on June the 1st, when the cell phones were sold, Best Performance cell phones would have debited accounts receivable Anthony Trucking Company for $21,000 and credited sales revenue for the same amount. Then on July the 15th, when they received the $5,000 payment, they would have debited cash and they would have credited accounts receivable Anthony Trucking Company. When they decided that they were not going to receive the remaining balance if they were using the direct write-off method, then they would have debited bad debts expense for $16,000 and credited accounts receivable Anthony Trucking Company for the same amount. Then in 2025, when they received the payment from Anthony Trucking Company with the note where they were apologizing, they would first need to set the accounts receivable back up by debiting accounts receivable Anthony Trucking Company and crediting bad debts expense for the $16,000. And then they would record the receipt of the cash for $16,000 and credit accounts receivable Anthony Trucking Company. And the reason why we set the accounts receivable back up is so that way we do have a record that they did come back and pay us, so that if they want credit in the future, we would be able to see that they actually had paid us at a later date. In Part 2, it asks us what are some limitations that Best Performance will encounter when using the direct write-off method. Well, we know that the direct write-off method violates the matching principle. So the matching principle says that we need to match the expense of the uncollectible accounts with the related revenue. Now, in this situation, all of it transpired within the same year. We recorded the sales revenue in 2024 and we also debited the bad debts expense in the same year. So that was actually okay. Where we ran into problems is when they came back in 2025 and we had to credit bad debts expense for the $16,000, because now this is affecting the bad debts expense in the next year. Whereas normally if we had used the allowance method, all of this would be going through the allowance for doubtful accounts and would not have affected the income statement in 2025. So the direct write-off method is not acceptable under GAAP, and it should only ever be used by companies that have just a very few uncollectible receivables. And that is the conclusion of the demonstration for exercise 817.